Hey everybody, it's Nick Barta with Security First Financial. Now, I wanted to talk a little bit today about cash out finances. I get a lot of questions on whether it makes sense for people to pull equity out of their houses and pay off some debt. And the other question I get is, okay, if interest rates have already moved up a little bit, did I miss my window? Is there, should I wait? Should I, is it too late? So we're going to cover a few of those things. First of all, as far as equity, certainly in the state of Colorado, we've had this great boom in equity over the last really 15 years. Certainly the last 2 or 3 years have been crazy. Appreciation's been up there in excess of 15%, sometimes 20, 25%. So just some crazy appreciation. And as homeowners, we've all benefited from that appreciation. So I want to show you guys an example of kind of, it'll cover two things. A, kind of what it looks like when you do a debt consolidation loan. B, a typical example of that. And then C, I'm going to show you interest rate wise where that's not necessarily the most important consideration when you're talking about cash out refinances. Certainly, we all want the lowest interest rate we can get. However, as far as rates move up and down, they're still at a very low rate today. Even if they move up over the next 6 months, cash out a lot of times still makes sense on a debt consolidation loan. So let me share my screen here real quick. I'm going to show you guys here kind of an example. I have a customer that we did a loan for quite some time ago. He purchased his home in 2018. Larry is a friend of mine, called me. He bought his house originally for $256,000. And you can see on here his existing loan. He did a FHA, or actually, let's change that because he did a FHA loan. It was a fixed rate loan. His interest rate was 4.5. Larry's been a little slow to do anything with his loan, so he's never refinanced. So at the end of the day, his mortgage payment was $1,427. So you can see from where he was to where he is now, he's gained, he's got $195,000 in equity. So he's got some room that he can do some things with. Now, the reason Larry called me initially is that he was looking to save himself $300 or $400 a month. He felt like he was a little bit overextended by $3,000 or $4,000 or $300 or $400 a month. And what he did, we're going to go ahead and put some loans in here. He has a vehicle loan that he purchased for himself. It's got about a $25,000 balance on it. His payment is $645 on that, so we're going to add that in there. His son turned 16. He had to buy his son a car, so he spent $16,500 is the balance on that, and his payment is about $457. So we're going to add that in. Now, with just normal stuff, he's got a MasterCard, just kind of with normal rate everyday, expenses that crept up on him. He had a few credit card debts that, he bought tires and didn't have the money for them, or they needed brakes and didn't have the money for it, or an insurance premium. And so over the years, unfortunately, his revolving debt, he's got a MasterCard that is stretched up to about $15,750. And so his minimum payment on that is $200 right now. So we're going to add that in. And he does have one other personal loan. It's a personal loan that he took out to do some debt consolidation on some other credit cards. And that's about $15,000. And his payment on that is $257. So we're going to add that back. So that's really what he has, and that's what he's got to work with. But you can see that his monthly payments are $1,559. Certainly can be a little bit constricting if you're, on the amount of money that you have. So we're going to continue with that. And if you look at where he is right now, his qualifying ratios, quite honestly, he's a little bit over what, we would be comfortable with if we were going to do a conventional loan with him. So we can go up to 80% loan to value, but we're going to limit this to 75 because it gets him a little better interest rate. And let's just say, he was at 4.5. Interest rates are still better, but let's just say with a cash out, it's 3.875. There aren't any points. He won't be paying any mortgage insurance, but his closing costs, he'll have about $4,000 in closing costs after everything is said and done. So we're going to take a look at that and see what he's got available to him. If he did nothing but just refinance his house, didn't pay anything off, he would save himself $325. Now, the problem we have is that his back end ratio is still a little bit over what we could do for conventional. So we have to look at maybe a debt consolidation loan. So let's say we go down here and he's got, he's got a chance where we could possibly pay all this stuff off. So let's see if we can do that. We pay everything off. That takes his loan amount to $306,000. And you go up here and it looks like, he would have enough equity to do that. It would take him to a 72% loan to value, and it would save him $1,544 a month in monthly payments. Obviously, the concern is spreading out the car loans and the revolving debt and everything like that over a 30-year period. However, let me show you how you can get away from that. So if he did nothing and he took his full $1,544 in savings, and he applied all of that towards the principal on the new loan, he would actually pay that loan off in 10 years and 5 months. It would increase his net worth by $168,000. So a pretty good deal for the guy. I mean, honestly, Larry was very happy to see that. However, he didn't come to me to increase his net worth. What he wanted to do was he wanted to get to where this monthly savings for him was $300 to $500. So let's go back to here and say, okay, we're going to change what he's, we're going to give him this $500 in savings, and we're going to use those values. So now, without paying anything more out of pocket, actually putting $500 more in his pocket, and he's still going to apply $1,044 towards his principal. What he's done is that he'll pay this loan off instead of in 30 years. He'll pay it off in 13 years and 2 months and increase his net worth by $146,000. Now, obviously, Larry was thrilled with this. We went ahead and worked up this deal for him, and he was able to, not only be debt free, other than his mortgage, he had this extra $1,000 that he could apply to his at any point in time to his mortgage. If he happened to have a month where some unexpected expenses crept up, he wasn't tied to that extra $1,000, so he could kind of move that around. But on certainly it gave him an additional $500 in his pocket, paid everything off sooner. Now you say, well, that's fine, Nick, but what if interest rates go up further? And I kind of had mentioned that, it's not necessarily about the interest rate. Let's say we're at 3.875. Let's say this goes up to 4.5%. You go up to 4.5% and you calculate that. Savings are different. He's only saving $1,432. However, if you go down here and you still have him save his $500 a month, and he still applies the $932, he still pays this loan off in 13 years and 10 months and increases his net worth by $140,000. So you can see that it's not necessarily interest rate driven. It is really about using the equity in your house. So if you have any questions, or if you want to participate in this exercise, give us a call. Again, it's Nick Barta, Security First Financial, 303-709-9625. Thanks so much and have a great day.